Hey everyone, welcome back to the channel, where we break down the complexities of personal finance and credit. In today's video, we're diving deep into one of the most commonly misunderstood terms in the credit world, APR, or annual percentage rate. If you've ever wondered how credit card interest works, or how APR affects your finances, then you're in the right place. Let's take a closer look at APR, why it's important, how it's calculated, and how it impacts your credit card usage. By the end of this video, you'll be better equipped to understand your credit card statement and make smarter financial decisions. So, grab a cup of coffee, and let's get started. What is APR? First things first, APR stands for annual percentage rate. Simply put, APR is the annual cost of borrowing money, expressed as a percentage. When you use a credit card, you're essentially borrowing money from the card issuer, and APR tells you how much that borrowing will cost you over the course of a year. Whether you're new to credit cards or have been using them for years, understanding APR is vital because it directly affects how much you'll pay when you carry a balance on your card. By the end of this video, you'll have a comprehensive understanding of what APR is, how it works, and how you can manage it effectively. Why is APR important? Whenever you don't pay off your credit card balance in full each month, you'll incur interest charges. These charges are based on your APR. So, the higher your APR, the more you'll pay in interest. This makes APR a crucial factor when comparing credit cards or deciding how to use them. APR, or annual percentage rate, represents the yearly interest rate charged on borrowed money. In the case of credit cards, it's the interest rate you'll pay if you don't pay off your full balance each month. This is crucial because any unpaid amount on your credit card accrues interest, and APR tells you exactly how much interest you'll owe over time. It's important to understand that the APR is expressed as an annual rate, but in practice, it's applied to your account monthly or even daily, depending on the credit card's terms. Second, know the types of APRs. Did you know that most credit cards don't just have one APR? That's right, different types of transactions can carry different APRs. Let's break them down. A is purchase APR. This is the most common type of APR and applies to the purchases you make with your credit card. If you don't pay off your balance in full by the end of the billing cycle, this is the rate at which interest is charged on the remaining balance. B. Introductory APR. Many credit cards offer a promotional or introductory APR for a limited time, typically on new purchases or balance transfers. For example, you might see a 0% APR for the first 12 months. After that period, the APR reverts to the standard rate. These promotional offers are great if you need time to pay off large purchases or transfer high interest balances. C. Balance transfer APR. This APR applies when you transfer a balance from one credit card to another. Some cards offer a lower APR or even a 0% balance transfer APR for a promotional period. However, keep an eye out for balance transfer fees, which can still add to your costs. D. Cash advance APR. Using your credit card to withdraw cash comes with a separate, usually higher, APR. Plus, cash advances often have no grace period, meaning interest starts accruing immediately. This makes cash advances a very expensive way to borrow. E. Penalty APR. If you miss payments or violate the card's terms, the issuer may apply a penalty APR, which can be much higher than your regular purchase APR. Penalty APRs can last for months or even become permanent in some cases, so it's crucial to avoid them by paying on time. 3. How is APR calculated? Now, let's get a bit technical. Your APR is a yearly interest rate, but credit card issuers don't wait a full year to charge interest. Instead, they break it down into a daily interest rate known as the daily periodic rate (DPR). Here's how it works. Find the daily rate. To calculate your DPR, the card issuer divides your APR by 365 days, some may use 360 days. For example, if your APR is 18%, your DPR would be 0.0493%, 18 divided by 365 equals 0.0493. Daily interest charges. The DPR is then applied to your average daily balance. This is why carrying a balance from month to month can quickly result in substantial interest charges. Example, let's say your average daily balance is $1,000 and your DPR is 0.0493%. The interest charged each day would be $1,000 x 0.000493 equals 49 cents per day. At the end of a 30-day billing cycle, that's $14.79 in interest charges if you don't pay off your balance in full. 4. APR versus interest rate. You might be thinking, wait, isn't APR the same as the interest rate? The answer is yes, kind of. Both terms refer to the cost of borrowing money, but there are key differences. Interest rate. An interest rate is just the cost of borrowing money. For credit cards, this rate can vary depending on the type of transaction, like purchases, balance transfers, or cash advances. APR. APR, on the other hand, includes not only the interest rate but also any additional costs associated with borrowing money, such as fees. This makes APR a more comprehensive measure of how much borrowing will cost you. For example, if a credit card offers a 0% interest rate on balance transfers for a year but charges a 3% balance transfer fee, your APR will reflect both the 0% interest and the transfer fee over that period. 5. Fixed versus variable APR. Another thing to keep in mind is whether your APR is fixed or variable. Fixed APR. A fixed APR does not change often. The credit card company might change it in certain circumstances, like when your payment is overdue or after giving you prior notice, but overall, it stays consistent. Fixed APRs provide more predictability. Variable APR. A variable APR fluctuates based on changes in an underlying benchmark rate, usually the prime rate. For example, if the Federal Reserve raises the prime rate, your variable APR might go up as well. If you have a variable APR card, expect changes in your interest rate over time. 6. How to avoid paying APR. One of the best strategies for using a credit card is to avoid paying interest altogether. Here are some tips to keep in mind. A. Pay off your balance in full. The simplest way to avoid paying interest is to pay off your entire balance every month. Credit cards typically have a grace period, which is the time between the end of your billing cycle and the due date. As long as you pay off your balance before the due date, you won't be charged interest. B. Take advantage of introductory offers. Many cards offer 0% introductory APRs on purchases or balance transfers for a limited time. If you need to carry a balance, using a card with a 0% intro APR can save you a significant amount of interest, just make sure you pay it off before the promotional period ends. C. Avoid cash advances. As we mentioned earlier, cash advances usually have higher APRs and no grace period. Unless it's an emergency, it's better to avoid them altogether. D. Make payments on time. Late payments can trigger penalty APRs, which are much higher than standard rates. Always pay at least the minimum by the due date to avoid these costly penalties. 7. How APR impacts your financial health. Now that you understand what APR is and how it works, let's talk about its impact on your financial health. A. Debt accumulation. If you carry a balance from month to month, a high APR can quickly add up, making it difficult to pay off your debt. Over time, interest charges can turn a small balance into a significant financial burden. B. Credit utilization. Your credit utilization ratio, the amount of credit you're using compared to your total available credit, can also impact your credit score. If interest charges cause your balance to rise, it can increase your utilization ratio, potentially lowering your score. C. Long-term costs. If you frequently carry a balance, understanding how APR works can help you minimize the long-term costs of borrowing. Choosing a card with a lower APR or using 0% APR promotional offers can save you hundreds or even thousands of dollars in interest over time. That wraps up our deep dive into APR. To recap, APR is the annual cost of borrowing money on your credit card. There are different types of APRs, including purchase, introductory, balance transfer, and cash advance APRs. Understanding how APR is calculated can help you make better decisions when using credit cards. Paying off your balance in full, taking advantage of promotional offers, and avoiding cash advances can help you avoid interest charges. Understanding APR is crucial for managing your credit card debt and staying on top of your financial game. If you found this video helpful, don't forget to give it a thumbs up, subscribe, and hit that notification bell for more personal finance tips. Thanks for watching, and we'll see you in the next video.